Bring in Neil Dutta, head of economics at Renaissance Macro Research, and Terry Wizman, global interest rate strategist at Macquarie. I cannot, stress enough the moves we've seen in the 10-year and the 30-year yields. And Terry, I'm gonna start with you because we saw a 15 basis point move lower in the 10-year today on the jobs report, but it wasn't that weak or that soft. So I guess break it down for me.
Well, look, compositionally, I think there were some soft things in the report. The more cyclical sectors of the economy, like construction, for example, and manufacturing, did see weak jobs growth, and the bulk of the jobs growth came in things that were not cyclical, like education and social services. So, when you look behind the curtains at the payroll number, I think it was on the soft side. Granted, other things were a little stronger, like wages, but I do think that July has been unusually strong for average hourly earnings, not just this July, but last July as well. And I suspect there's a problem with deseasonalization filter at the BLS. Putting that aside, this is a mixed report. I will stress, however, that when it comes to the bond, there really are two narratives out there in the marketplace. There's one that says inflation is going to come down, and therefore bond yields should come down. But there's also this narrative that says that there's going to be a massive wave of issuance coming from the Treasury because of the federal government's incessant spending. And those two narratives are competing with one another. That's why sometimes you see the bond yield fall a lot, and some other days you see it rise a lot, depending on which narrative is in effect.
Yeah, and of course, then layer in Bank of Japan and some of the policy changes we're seeing take place there. Neil, I want to get your thoughts on this and whether you agree.
Well, I don't think it was a soft jobs number. We're continuing to generate fairly robust job growth on average over the last several months. I take the point about, certain industries dominating the growth in July. But, when you look at wage growth, it's actually the cyclical industries that are showing the most robust growth in average hourly earnings. Take a look at goods producing industries and average hourly earnings in those industries. It's surging, frankly, over the last 6 months. I think the labor markets are fine. The unemployment rate is at 3.5%. And I think the risk, frankly, is that the economy reaccelerates. You mentioned construction. New home sales are up about 20% over the last year, and single-family starts are actually down. That's not a sustainable condition. Ultimately, starts are going to have to pick up, and when that happens, builders are going to have to find construction workers to fill those jobs. And these are homes we've already sold, frankly. So, there is some risk, I think, Morgan, that the labor markets actually reaccelerate here.
So, translating this to the markets, then, Terry, the equity risk premium, sort of what you can expect to get paid for buying stocks versus government bonds, it's at a 20-year low. So taking everything else out, what, if anything, should that tell investors at home about how they should be looking at their portfolios?
I think they should be favorably disposed towards bonds right now in the belly of the curve, maybe around 5 years. Those yields, I guess yesterday were at about 4.25. That's quite attractive. In view of the fact that we probably are seeing a disinflation in the U.S. and it's going to continue into the end of the year. And as a result, the Fed is going to offer much more clarity on peak interest rates. The only thing holding back yields from falling, like I said, is this suspicion that there's a massive wave of issuance coming. But at the same time, hedge funds and most speculators are very short the bond right now. If you look at the futures market, there's a huge short position. So any news that smacks of lower inflation or a bit of a slowdown in the economy will make those bond yields come down a lot.